Well, good afternoon, everyone, and thank you for joining today's call. My name is Donald Pershall. I lead the Training and Competitive Services Unit here at Global Atlantic. My counterpart, Kyle Veenstra, he is having some internet difficulties, so he is not joining us this afternoon. So just a little bit about myself. Been in the financial services industry for over 20 years. Spent part of that time as a producer, as an agent and financial advisor, but the majority of my time has been in home office work. And so what we're going to do this afternoon, if you were on this morning's call, you're going to see a little bit of repetitive information, but we're going to go a little bit deeper into the IUL marketplace. You probably saw, Multiplier marketplace 201. And we are going to talk about that, but I think when you really take a step back and look at the IUL marketplace, it is the multiplier marketplace in today's environment. So I think it's really important to understand the mechanics and the pieces behind the scenes that are going on, so you have a better understanding for what you're looking at and what you're doing for your clients. So we're going to spend some time going through a lot of different pieces here. If you have questions, as I said before, please use the Q&A section to post those questions, and I'll try to address them as we go, or we'll do a little Q&A session at the end where I'll respond to your questions and we'll talk through. The goal here is to do about 30 to 45 minutes presentation, and then I can stay online till about the top of the hour, so about 4 o'clock Central, handling questions as they come up. So again, really appreciate you guys taking time out of your day. And for those of you who attended the 101 session this morning, thank you for coming to the 201 as well. Hopefully this kind of builds on what you heard this morning and gives you a little bit more understanding. I think the first thing that we have to understand is the financial services market and the life insurance and IUL market is not much different than other product markets out there. There is a solution, a size, a design, a model to fit whatever your client need is. And I think it's important for us to really understand that, and that there is no one size fits all for every client in the marketplace. I used the analogy this morning that if you were to take your car into a mechanic, and the mechanic walks out and says, well, I've got and you're like, well, where's your toolboxes? Where's everything? And he's just holding a hammer. You probably wouldn't leave your car with that mechanic because he has one tool. And it's no different for our clients. We need to make sure we have the proper tools for the different situations that they may be facing. Life insurance can, cash value, life insurance, index universal life is a great solution for a lot of different things, but it doesn't work for every situation that's out there. So I just think it's really important that we acknowledge that. I work for a permanent life insurance carrier, and but I think if you talk to anybody within our organization, we would say the same thing. It's not a one size fits all for everybody, but there's a lot of different products and components out there in the marketplace to help solve your clients' needs. The one thing that I can guarantee you in this marketplace and financial services, and there's constant change. We've seen it. I've seen it throughout my career. We continue to see change, and truly trying to understand what's going on and what's next is always the big question. And it's probably one of the questions that I get most when I talk with folks is, what do I see next? What do I see happening coming in the future? But I want to talk about some of the change that's happened recently that I think, we're all aware of, but I think it's important to highlight. January 1 of this year, all life insurance products were required to comply with the 2017 CSO table. So CSO is Commissioner Standard and Ordinary. It has to deal with mortality. So we're going to really dive deep into what that means and how that actually is impacting product design, because that definitely has changed the way a little bit how products are being designed and priced. So I want to make sure we all understand that. I mean, when you talk about an IUL, Index Universal Life, you can't talk about it with talking about caps and participation rates. So we're going to dive deeper into, the caps and participation rates what impacts those caps and participation rates and some things to kind of watch out for within there, and understanding, what markets are good for IUL from a pricing and cap and participation rate standpoint, which ones are most challenging. But there can be good, strong products no matter where you're at. Within the IUL market, we have seen a ton of activity of new products, product updates within the last year. In 2019 alone, there were 30 either new or updated products that were released, with over half of them being released in the fourth quarter alone. IUL continues to be the fastest growing product in the life insurance marketplace. Whole life continues to be the top overall seller, but IUL is slowly gaining ground on whole life. So it definitely is here to stay. It is a product that meets a lot of different needs, has a lot of flexibility, and a lot of things that people are looking for when they're looking for a life insurance solution. Within IUL, the value proposition has always been upside potential with downside protection. As new product designs with multipliers and other features have been introduced, we're seeing a change in that value proposition. So I really want to spend some time diving deep there, talking about that change in value proposition, what you're really seeing within the mechanics of a product. And then I'm going to spend a little bit of time showing you a couple of examples of what that means for our products. So we have Lifetime Builder Elite, which is a product that does not have multipliers. And then we have Global Accumulator with smart buy-up options. So those smart buy-up options are our version of multipliers or bonuses, depending on what vernacular or what terminology somebody may use. And then the final thing that I want to do in today's presentation is give you a few kind of snippets and competitive advantages of our Global Accumulator product and why we built it the way that we did. So let's dive into 2017 CSO. And what does that really mean, and why is it important to understand what it meant for life insurance contracts? So 2017 CSO was just a measure of mortality, and people are living longer. So because people are living longer, we're seeing improved mortality. The cost of insurance, so kind of that cost of insurance per thousand charge, when you look at it, it's lower than what it was on the prior mortality table, which was the 2001 CSO. What that means for products, if the mortality table was the only thing influencing pricing on death benefit guarantee products, it would mean lower premiums to guarantee the product for whatever that duration is. But we all know that that mortality table isn't the only thing influencing pricing. Interest rates and other market dynamics are definitely playing into that pricing. In the way that carriers have to reserve for that death benefit guarantee. So there's been changes with how that reserve has to happen. So it was in 2013 that reserve requirements changed, and then additional changes have been moving up through last year where everyone had to comply with principles-based reserve. So that reserving requirement changed on those guarantee policies. So between the reserving requirements and the interest rate environment is why you're seeing death benefit guarantee premiums actually going up, even though the kind of mortality is improved, so that mortality exposure is improved, but other market factors have shifted opposite that mortality exposure. On the accumulation focused products, how 2017 really affected it is the MEC premiums. So if you look at a 2001 CSO product versus a 2017 CSO product, and you put the same exact face amount in from the same carrier, what you're going to see is for the same face is your max funding or your MEC premiums will be lower on the 2017 CSO product. For the same premium, if you're putting in, let's say, if you're putting in $10,000 a year, you're going to see a higher face amount on the 2017 CSO product. So why is that important? Well, the reason why that's really important is charges within a policy are based on what's called the net amount at risk. So the difference between the death benefit and the cash surrender value. So you look at that difference, and that's what insurance companies on UL contracts actually charge the cost of insurance on. And I'm going to walk through that more in depth here in a few minutes and show you a scenario using one of our products to actually show that side by side. So those things really impacted how contracts are being constructed. So carriers are continuing trying to figure out how to ensure that, compliance with the regs, but also still making an efficient product for the clients, which is why you see a lot of different changes and innovations that were introduced last year, and why so many changes were made in the fourth quarter is because for some products it was disadvantageous. So it wasn't as good, as far as funding levels to be able to max fund when they had to move to the 2017 CSO. So they delayed that move until the end of the year. That way they could offer a more attractive product from a funding perspective to the clients on an accumulation sale as long as they could, because January 1, 2020 was the compliance date. So the impact on case designs, if you've noticed, same face amount, you've got a lower max funding limit, which in turn gives you a lower illustrated distribution. On the same premium with a higher initial face amount, again, you're going to see lower illustrated distributions, all because you have a larger net amount of risk. Just wanted to show you that kind of mortality curve and how we've seen that mortality curve improve. So this is great. It's great. People are living longer. We're seeing mortality improve overall. If you compare that top line, up here of the 1958 mortality table to the 2017 mortality table, we've seen great improvement in life expectancies. So that's great. But what that does is on the MEC premiums, when you start to compare those premiums, so this is looking at the MEC premium for a $500,000 face amount for a male non-tobacco 45-year-old. But as you can see, so this dark blue line, so the bar here and below is the 2017 CSO MEC premium for a $500,000 face amount. The green, right? So the green is your 2001 and the blue is the 1980. So you can see the CSO tables update around about every 20 years, once they've updated the mortality studies, but you can see how there's been a significant drop in those MEC premiums. Obviously on the younger ages, your drop is not quite as drastic as the older ages. So I know I've gotten a few questions from some advisors that I know about, well, why in the older ages is it tougher to really build a max funded case that looks as attractive as it used to? And this is why. You've got that lower MEC premium, which means you have that much larger net amount at risk for a longer period of time. So that's putting a drag on the policy because you have more charges for a longer period of time. So it takes other crediting mechanisms, other things to kind of overcome that larger spread, which is why you see carriers introducing things like bonuses and multipliers in order to help find ways to boost crediting, and charging for it in different ways, because most multipliers and bonuses, as we'll talk about here in a little bit, are funded by asset-based charges. So charges that are explicit, that the client sees, I'm going to pay 4% of whatever my value is, or I'm going to pay 6% or 5.25%, whatever that may be. So they're finding other ways to boost the crediting in order to help narrow that net amount of risk over the life of the contract. So things to remember about 2017 CSO is people are living longer. You've got lower MEC premiums. So those lower MEC premiums are what is affecting that accumulation value because of that larger net amount of risk. I also think it's important to remember all UL products, because Index Universal Life is just a universal life product. The only difference between it and another universal life product is the way the interest is calculated. So index universal life, it's based on an index versus maybe a declared crediting rate or on a variable product, separate accounts. So it's also important to remember these three things. And I think sometimes we forget about these things with UL contracts, but the first one is the primary guarantee. Primary guarantee says as long as I've got cash value in the contract, I have a death benefit, right? Secondary guarantees are those no lapse guarantee provisions, you know, things that are in a guaranteed universal life, you know, product. So, you know, it's remembering that, hey, there's still that, not every product has a secondary guarantee, but every universal life product has a primary guarantee. And then the flexibility of premiums. This is something that you don't see in other products. And I think it's what makes index universal life and other universal life products so attractive is that flexibility. If I've got sufficient cash value to provide that primary guarantee, I have a decision point as a client to decide how much or how little I want to contribute, as long as I stay within the guidelines when it comes to how much I want to contribute. And the other piece to always understand and look at when I dive deep into a product, and this is where the net amount of risk comes into play, is what are the charges? What charges are built into the contract? What's my client really paying for? Almost every carrier in the marketplace today has an expense report that will lay out for you the premium expense, policy expenses, cost of insurance, and rider expenses. And now with the advent of multipliers and bonuses, it will show you your asset-based charges. That are also, most carriers out there are showing those credits broken out by each of those things too. Your standard index credit, your multiplier or bonus credit, and then any other non-guaranteed elements that might be part of it. But understanding what these charges are and how they're charged, premium expense is always a flat percentage of whatever premium is paid, regardless of what carrier you look at. We all kind of do it the same way. We all don't have the same percentage, but you know, every carrier is all within about the same range. Policy expenses, those are charged on a per thousand of face amount. So that's not on net amount at risk. That is literally on the amount of face. So if you buy $500,000 of coverage, that policy expense is based on that $500,000. The cost of insurance is the one that always, you know, gets the most questions because it's charged on a per thousand basis based on the net amount at risk. Net amount at risk is the difference between the net death benefit and the account value minus loans. So you're really looking at kind of the net cash value and net death benefit, what that spread is between those two. That's the amount that the cost of insurance is actually charged on. So it's a per 1,000 charge, and you figure out whatever that amount is. We're going to walk through an example here in just a second, just to dive a little deeper and kind of peel the onion back, because it is a question that I get fairly often is when people are comparing products, even the same product back and forth. And with multipliers and bonuses, there are more charges in the contract than before. With multipliers and bonuses, you add in an account value or an asset-based charge. So much different than what you see on the screen, because rider expenses, we understand a term rider, or, you know, accidental death benefit or additional insured, something like that. But with an asset-based charge, it introduced a new charge or a new expense that didn't exist in previous UL designs. So when you introduce that asset-based charge, now you have a charge that is a percentage of whatever that asset that it's being secured against. So if it is a multiplier, it's usually against the index account that the money is allocated against. So as that index account value grows, it's a percentage of a larger number. So it's something to keep in mind and understand, is that additional exposure and additional expense. So just to kind of give you a quick example, I ran our Global Accumulator IUL, which is our newest product with Multiplier. I pulled up the policy expense report, and I've got part of the illustration here, just a snapshot. So I ran one at 6.84% and one at 5.47% to show the difference, so that the COIs on the current basis are charged the same amount. So the per 1,000 charge is the same, but the actual amount, so if you look at this, if you look at the base cost of insurance charges between the two different policies, you notice that on the lower illustrated rate, they're higher. And the reason is because you have a larger net amount at risk. So if you look at the net amount at risk, that net amount at risk is the difference between these two columns. And you can see that there's a larger spread between those two columns, hence why that COI is higher. So if I blow that out and just show you, end of year age, so at age 60 on this, and this was a 35-year-old, our net cash value, our net amount at risk, and the base cost of insurance at that age, you can see that because of that larger net amount at risk, it's driving this larger COI. So the other thing you have to keep in mind is when you have that multiplier or bonus, on top of this, you now have introduced another expense that is a flat percentage against your account value. So if I look at, you know, a typical policy, I started taking loans on this policy, but you can see on the lower illustrated rate that a net amount at risk stays higher for longer. So how you fund a contract, because the way that you improve your net amount at risk is crediting that you get and how you fund it. So how you fund that contract is really important for accumulating as much cash as possible, because the more you can shrink this difference in here, the better it is for your client. Your client's going to pay less COIs to the insurance company, and it's going to help them with their accumulation values. And especially in these multiplier products, because of, you know, when you have those positive returns, the additional upside that it creates for that client. So things to remember is the larger that net amount at risk, the higher your COIs. You're going to see different COIs even when illustrating the same product at different rates. From product to product, carrier to carrier, COIs are going to be very different, but it's still all going to be based on net amount at risk, and proper funding is ultimately important. So the next part is, well, what's driving cap rates? We've seen a lot of movement in cap rates. Carriers have lowered things. We even lowered our caps recently. And so I want to talk a little bit about that and how that impacts not only the base part of the contract, but also the multiplier side. There's really two things that drive the cap and participation rates that a carrier can offer. One is, what's the return we can get on our portfolio, right? So, you know, when we have a charge built into the contract to provide for an option budget, we have to invest that in very secure fixed interest type vehicles. And when you look at where the current Moody's corporate bond is, gives you an idea of where interest rates are. And this is looking back over the last 10 years. So that money that we were taking and investing, we're now investing at a lower rate. So the amount of money that we've set aside for option budget, plus the return we're getting on it to apply to that, is less because of that lower interest rate. The second big influencer to cap rates, participation rates, is volatility. Option prices follow volatility. You know, so as volatility increases, option prices increase. As volatility decreases, option prices decrease. And within Index Universal Life, I think we all know this, we're not investing directly into the S&P 500 or whatever that index may be that the carrier is offering. The carrier is taking and buying options in order to provide that crediting benefit to the policy. So when you take these two pieces of lower interest rates and the lower rate of return on the portfolio, and then you take higher volatility that we have seen, particularly since, you know, COVID-19, you put those two things together and you kind of have this kind of perfect storm of that upper left-hand quadrant. We've got low long-term interest rates, high market volatility, which is going to drive down cap rates and participation rates. So you're going to see if the volatility persists. Now, the good thing is volatility has actually come down. It's coming down from even where it was in that chart that I just showed you. But if volatility continues to be extremely high and interest rates remain low for long, it's going to impact long-term cap rates and participation rates on products. Kind of the perfect storm for IUL is that bottom right-hand quadrant. We get interest rates that are higher over the long term, and market volatility really drops. The value proposition of IUL, as I talked about earlier, has really changed. And the multiplier products is what changed it. This was my kind of perception. What you're going to see come up on the screen is kind of my perception of how I felt like multiplier and bonus products were represented in the marketplace when they first came out. So first, what you see is the current, the traditional IUL value proposition. We've got upside potential, downside protection, right? The client saying, hey, by buying an index product, I'm willing to give this up to not have to experience this, right? So willing to give up that extra upside to not have to experience the negatives, the negative crediting to the policy. And then multiplier and bonus products were introduced, and they were represented, or at least perceived in the marketplace, in my opinion, as what you see on the screen here. Well, I get this bonus, but I still have my IUL value proposition as it's always been with that downside protection. I just get more upside. But we all know you don't get anything for free. And what was created is this diagram that you see on the screen right here of we've got additional upside potential, but now we have potential for negative returns on beyond. We all know life insurance contracts have expenses. If you get a 0 in an IUL, your account value is going to go down because you have expenses. But now we've introduced this additional expense, this additional exposure that's directly related to crediting and is directly related to their account value. So it's that additional asset-based charge that I don't think was really truly represented. Now I think it is much better now. And I think that people are doing a much better job of representing the risk that's involved with multiplier products. Great question of what conditions really favor multiplier products over the traditional IUL. And it depends on the product, but if the index return, if you're averaging north of 6.5%, 7%, and you believe, your client believes that's going to be pretty consistent, with most multiplier products, they're going to outperform from a crediting perspective your traditional IUL. But you have to remember you're giving that charge, so it takes quite a while. I said earlier today on the call, what's better, what fits, and I think it really comes down to client risk tolerance. Some clients, they want this, right? They know this, they understand this. They're not willing to take additional risk with their money. Most clients that are heavily funding life insurance contracts, I always used to like to say that was their safe money. So they were looking for, the best way to protect that while still giving themselves potential for upside growth. But there's a lot of clients out there who, are willing to take on some additional risk in order to get even more additional upside potential. And I think when you look at, long-term market conditions, I think both designs have their merits, especially if you can get a traditional IUL with a higher cap because you've got more capacity. So in those big up years, you're getting quite a bit more without having to give up that additional charge. So it really boils down to kind of client risk tolerance on which one is kind of best. Market conditions, it's tough to say. but the analysis I've done, it's looking north of 7%. If you think you can average north of 7% based on the index, in a lot of scenarios, that IUL or the multiplier product's definitely going to outperform. And I was with one of our products, we have history going back numbers of years, and it's averaged actual crediting north of about 6.4, 6.5%. And I would say that, depending on the design of the multiplier product, it might do a little bit better than the traditional product. It's just in the up years, they're just going to see a lot more up in the multiplier product than in the traditional IUL. But in the lean years, that asset-based charge is really going to impact the contract. So as we talked a little bit about, the multipliers and the bonuses, it's really important to understand what's under the hood of the contract that you're looking at. Traditional IUL has an index option budget that gives you your cap and your par rate. So that's built into the contract. The insurance company's investing that in secure things and then buying options in order to buy that. Multipliers and buy-up strategies still have that base index option budget for the cap and par, but now they're charging an explicit charge to provide a secondary option budget to buy another option because that's essentially what the insurance company is doing, is they're buying an option that's funded by a direct charge to the client that's explicit. They know exactly what that amount is in order to be able to go out and buy another cap and a par rate on an option. There's also flat rate bonuses and enhancements. So in my opinion, there's been multipliers or bonuses in the marketplace basically since IULs were introduced. And, most of those were delivered through either, some sort of flat rate bonus or enhancement. We call ours an account value enhancement at Global Atlantic. And it's a fixed rate and it's multiplied by the account value. And that gets you your total bonus amount. So the great thing about these flat rate bonus and enhancements is it doesn't matter if the contract returns 0, they still get the bonus because it's a fixed rate multiplied by the account value. There's also percentage multiplier bonuses those are a little bit newer, where it's a percentage of the index credit. So the drawback here is if you don't get positive index credit, you don't get that kind of account value enhancement or that multiplier. And this is where, there were some that are built into contracts. So it's kind of the no charge, no additional cost. It's just a core part of the contract. The most common in the marketplace is 15%. Typically they kick in around year 5 or year 10. I haven't really seen any carriers out there that are offering anything in between that. And then, so the nice thing about those is it's stated, they're not paying extra, it's just kind of baked into the contract. But an example of that, within our Lifetime Builder Elite contract, we have a 100 basis point account value enhancement. So that's not dependent on index crediting, it's just 100 basis point. So the competitive advantage of that is, if you look at my example here, if it's a 15% no additional cost kind of bonus or credit, their contract has to return 6.67% before it equals 100 basis point. Now, when the crediting is above 6.67, their contract's going to get more on that additional bonus than our 100 basis points. But our 100 basis points is very competitive, and you have to look within each contract. About half of these are guaranteed within the contract. About the other half of the carriers in the marketplace, it's a non-guaranteed element. Ours is the guaranteed element. But there's quite a few of them out there that are non-guaranteed. But almost every contract has some function of this built into it. So I would say kind of that multiplier idea has been around for quite some time. It's not that new, it's just the adding in the additional cost. So what you see on the bottom, the explicit charge, is what makes a difference. So what the asset-based charge does, it takes away that zeros or heroes we already talked about. But if we look at an actual example, so let's say there's a 4% asset-based charge. So you take 4% times that index account value, that equals how much it costs you to have it, right? So then you look at the bonus is 55%. So you take 1 plus 0.55 times your credited rate. I use the same as above, 6.67. So your gross credited rate would be 10.34. But remember, there's a 4% charge. So your net in this example would actually be down to 6.34 would be your affected credited rate. And I think that's the piece that a lot of people don't see. They see the 10.34, but they forget about that additional charge that they're paying to get that 6.34. So in this scenario, I would call this out of the money, or it cost you more than what you got credited. The other thing is understanding the difference between illustrated rate and credited rate. One of the most common things I see in the marketplace is everyone says, or not everyone, I see a lot of people say, well, I need to run everyone at the exact same illustrated rate. And I think that is, we've kind of done that to ourselves as an industry. But when you look at the different products, every product has a different feature set. Every product has a different cap, different floor. If it's got multipliers and bonuses, those work different. So it's not as simple, in my opinion, to just run everything at one credited rate. And the reason is this, just to show you an example. So if we took a traditional IUL versus 2 multiplier products, let's say that traditional IUL had a 13.5% cap. For AG 49, based on these caps and the floor, because AG 49 prescribes exactly what your max illustrated rate would be, and that's based on a 65-year look back, looking at 25-year rolling periods. So it's taking basically the average credited rate for those 25-year rolling periods over a 65-year look back. So in this example, on this traditional IUL with a 13.5% cap and a 0% floor, your max illustrated rate would be 758, and on these multiplier products, it'd be much lower. So you look at that and you go, well, gosh, that traditional IUL looks great. It's got a high cap. It's going to have a higher illustrated rate, right? But when you actually look at the average credited rate to the policy at the end of the 25th year, on the traditional IUL, assuming there's a 100 basis point account by enhancement, your credited rate is 858, your average credited rate. On the multiplier products, you can see 1185 and 1209. That's great. That's additional upside potential. But what you have to remember is that might be your average credited rate, but each year, your average asset-based charge is about 4.5% or 4%. So when you back these down, so on the far right, multiplier product 2, your average net credited rate would be around 8%. Your average net credited rate here is let's say 7.5, just call it simple math. So when you're really looking at a product, and if we said, hey, we're just going to illustrate everybody at 6%, that seems to be a common thing. Well, if you did that, you're actually illustrating these 2 products in that scenario at the max AG 49 rate. So that's where I feel, it makes more sense in my opinion. It takes extra work, I get it, to look at products at maybe 10% reduction of their max illustrated rate, or 20% reduction of their max illustrated rate. So I think it's really important to look at how we're analyzing the products, especially with the advent of multipliers and asset-based charges. So one of the questions is around our smart buy-ups. I'll talk about them here in a little bit more, but clients want to have a choice in terms of asset-based charges. So the way we've got our buy-ups or our multipliers is we have triggers for those, and I'll go through those. But within our contract, clients don't have to be in a buy-up strategy. They can choose to still be in the standard 1-year point-to-point and not have any asset-based charges. Another question was around, does IUL provide living benefits for both adult and kids? Ours does not provide living benefits for kids. I'm not aware of any other carriers that do, but I could be missing 1 or 2. Typically, it's for over 21 is most of the living benefits that I see in the marketplace. So let me give you an example on our products. So this is looking at Global Accumulator with really just 3 of the index strategy options. So if we look at the 1-year point-to-point, the Smart Buy-Up Secure, which Smart Buy-Up Secure is a 25% 25% buy-up add-on. You can see that over here on the right side. And I'll go through these a little bit more in depth here in a little bit, but I wanted to put this in right after that other crediting example. And then we've got our Smart Buy-Up Performance, which is 110%, but with both of those, they both have asset-based charges, right? So for the more you pay, the more you get. But what we did, one of the things that we did that we thought made these smart, with the Smart Buy-Up Secure, the account value enhancement is 125%, or 1.25. Well, the charge is 1.25. The account value enhancement starts at the end of the 5th year. The Smart Buy-Up Secure starts anytime the account value enhancement's been paid. So the charge is offset by the account value enhancement. Likewise, with the Smart Buy-Up Performance, so for that one to kick in, the account value, so that net account value needs to be 20% of the death benefit. And then at that point, then we would start the asset-based charge. What we thought is in the early years, that gives time for a little bit more compounding before we start adding in an additional asset-based charge to the policy. Again, you still have the account value enhancement that helps offset some of that charge. So the example that you see on the screen has the 1-year point-to-point and then the 2 buy-up or multiplier strategies that we have. This is assuming if you have a 0% index change, so a year that you get 0, you know, if we had a beginning segment value of $1,000, we've got a cap rate of 10.5%, your buy-up charges, the actual charge in dollars, and then your net segment starting value, so your index segment starting value, which is what things be credited on. When you go all the way across, obviously there's 0 crediting, but then you see your account value enhancement still come in, and while it's not an exact wash, it's very close to washing on your Smart Secure. So we tried to protect the client by having that be offset by the account value enhancement. And then you see a little bit more because you do have an asset-based charge here on your Smart Performance. So if we walk that through and we say, okay, at a 6%, if we get 6% credited, how does that same thing happen? And as we go across the numbers, still see the same net segment starting values, but now you see your index credits, you see the percentage, and then you see your buy-up add-on. So that's your multiplier credit that you're getting. Then you get your ending segment value, and the account value enhancement is actually credited based on the average monthly balance of the account value. So we take the average monthly balance of the account value throughout the year, and that's what we credit the 125 basis points on. And you can see over here, now at 6%, that both of the buy-up strategies start to outperform the standard 1-year point-to-point. So within our product, you get above 6%, you're going to see better performance long-term out of the buy-up strategies. Not every carrier is that way. We don't have any other non-guaranteed elements going on, any additional, performance credits or anything else that, triggers. That's something you need to look at with each carrier because every carrier is a little bit different. Some may have guaranteed multipliers, but then they have an additional non-guaranteed element that helps boost performance. And most of the carriers have done a pretty good job of putting a report out there so you can actually see those values and be able to evaluate what's actually going on within the contract. That's something I look at every time I'm evaluating the contract. And then if we said, hey, the index changed at 15%, well, the contract's going to cap out at our 10.5% cap. So we can see our index credits over here. We see the buy-up add-on dollars amount. Well, now this Smart Performance really starts to really starts to perform because you got 110% of the 99.49, and now we're starting to really separate ourselves. So the difference performance is going to make a big difference in what your client sees at the end. If you've got a client that really believes, hey, I think the market's going to be really strong, it's going to go gangbusters, you know, they're probably going to be seeking out the buy-up performance strategy. You know, this is just showing all three. Got a question about, you know, not seeing the Smart Secure in Builder Elite. The two buy-up performance strategies are only available in Global Accumulator IUL. That's the only one that has the buy-up strategies. Lifetime Builder Elite is still the same core traditional IUL product that if you've been selling with us for a while, that you know. So nothing really has changed within that product. So things to remember within bonuses and multipliers is they do provide additional upside. I hope nobody takes any of my comments to say I don't think these products are good, because I do. I think they're very good for that client that is willing to take on a little bit of additional risk. It does give them a lot of additional potential on the upside. But making sure that they understand that there is additional risk, but you're getting that additional upside. There's a cost. That asset-based charge is built in there. And the other thing that you really have to dig into is what are the other non-guaranteed elements that are affecting the crediting within the policy. I think when you really dig into that, look at some of those pieces, you know, it's very eye-opening to look at what's within the contract and what elements are guaranteed and what are not. So from a competitive standpoint, where does Global Accumulator stack up? This is looking, you know, this is actually before some of the cap rate changes that have been taken by other carriers. This is at our current caps, you know, at max illustrated rate. You know, this is a male 35. This is just looking at max projected distributions based on a minimum non-MAC design. If we drop it down to 6%, because that's what benchmarking companies like to use, so it's a little easier for us to put together, but 6%, you see Global Accumulator Smart Performance moves to the top of the grid. I think what you will see when you look at Global Accumulator versus other products in the marketplace, it's going to be top 3 in almost all age and gender cells until you get in some of the older ages. There's 3 other competitors that, you know, to be honest, they tend to be a little bit more competitive, you know, when you start to get over age 60, but we're still going to be up there in that probably top 3, maybe top 4 once you get over age 60. So still a very, very competitive product. I said I've jumped a couple of things. I know we're kind of running over, but I wanted to talk, I'm going to kind of jump through, talk about the smart buy-up strategies that we have. I talked about them quite a bit on the numbers slide, but just to reinforce, with our smart buy-up secure strategy, so it's based on S&P 500. Within Global Accumulator, clients still have the option of just the 1-year point-to-point. There's no asset-based charge, no buy-up add-on or anything else to it. But with the Smart Buy-up Secure, it's the first kind of buy-up strategy. Smart Buy-up Secure starts at the beginning of the 6th policy year. We start paying an account value enhancement at the end of the 5th policy year. The buy-up add-on percentage is 25%. So we think it's smart because we waited until we start paying the account value enhancement, and the account value enhancement helps to offset that charge for that buy-up add-on. So we think that's a smart way of designing it to allow the cash to accumulate before we add in additional asset-based charges. Our Smart Buy-up Performance, which has a 110% buy-up add-on percentage, but there's also a 5.25% buy-up add-on charge. And the trigger for this, what makes this one smart, is we don't start charging the client the 5.25% until their account value is equal to 20% or greater of the face amount. So we don't start charging it until it hits that threshold. they also don't get the additional buy-up add-on percentage until they hit that threshold. But that 5.25% charge is a pretty hefty charge. So we want to allow the contract to get enough cash value in it to where it can support that additional charge. The other thing that makes this smart is on the back end. As clients are taking distributions, maybe that account value is dropping. If that account value drops below that 20% of the face amount, we actually shut the charge off and shut off the buy-up add-on to help protect from that additional charge potentially causing a lapse on the policy. So we believe that's a smart way to deliver that benefit. We've heard mixed feedback, but we just felt in order to try and preserve as much of that IUL value proposition as we could while still offering people the additional opportunity for additional upside potential. Again, that 5.25% is partially offset by the 1.25% account value enhancement on the contract. If you think about it from a risk-reward spectrum, Global Accumulator with just the standard 1-year point-to-point, it's your traditional IUL value prop. You've got your account value enhancement of 125 basis points. And then you've got your Smart Secure and Smart Performance. The question is, can the policy owner choose to move into the Smart change from the Secure to Performance later after the policy is in force? Yes. You can actually make a change to in Global Accumulator and in Lifetime Builder Elite, you can actually change your allocations. Each year, you do have to notify us before the end of that index crediting period so that the money can move at the end of that crediting period. But yes, they can move it later on. So with Lifetime Builder Elite, as I said before, there's no buy-up strategies available there, but it still has that same flexibility for clients to be able to move between strategies, at the end of each index crediting period. Another question around, if we don't charge for the buy-up performance until the account's 20% of the face, if you have a big 1035 in year 1, can that bump it up? It can. So where I see the performance trigger happening the earliest is 1035 situations, because that really supercharges the funding of the contract and can get you to that 20% funding threshold that much sooner. That's really where you're going to see the Smart Performance kick in sooner. So, that's really the way to supercharge it. There's a question around the, how is the multiplier contract affecting the distribution cycle? So nothing really changes on the distribution side. When people start taking distributions, the money can stay allocated to the multipliers just as they had previously. The one thing that's going to change is if they're in the Smart Performance, strategy, if the account value were to ever drop below that 20% of that face amount, we're going to shut off the multiplier part of that strategy to help protect the contract. But otherwise, there's no difference on distribution side for the Global Accumulator versus Lifetime Builder Elite or any other kind of UL contract. So want to hit on a couple of more things, and then we'll kind of focus on the question and answer. But within this contract and within Lifetime Builder Elite, we do have a 2% minimum interest rate guarantee in both of those contracts. That's a nice kind of safety net feature that's built in. We also offer our chronic and critical illness riders called Accelerated Access. It's not currently available in California. We hope to get approval at some point. Don't know when. I wish I did. But this is a great benefit. There's no cost, no additional underwriting. The cost to the client is if they accelerate the benefit, we charge interest on the amount they accelerate. So it's one of those no-cost riders that there's no reason not to have the contract issued with it. And so just a couple of things on, why to buy Accumulator is the buy-up strategies, we think we've designed them in a smart way. The account value enhancement that really helps boost policy performance, overall accumulation potential, flexible options on both the accumulation side as well as some of the loan options. We have 3 loan options. We have a fixed loan, a variable loan, and we have what's called linked, which introduces upside potential, downside protection to loans. And then our Wellness for Life rider. We were the first one to introduce a wellness rider on life insurance contract. We've had it out for over 10 years. It's very simple. The client goes to the doctor and they step on the scale. And just by going to the doctor every 2 years, they automatically can qualify. So it's a very simple rider for your client to qualify that can help with the COIs, because it actually goes back as a credit to the policy based on the COIs that would be charged. And then just wanted to give a quick promo for next week. We're continuing our summer training camp. Some of our advanced markets team will be coming on. The 11 a.m. webinar will be focused on the stimulus package that was just released. And then the 3 p.m. will be focused on the Secure Act and opportunities that has presented for the insurance industry. So one of the questions we have is, if somebody's approved for Build or Leap, can they still get the policy issued with Global Accumulator? Yes. If the policy hasn't been issued yet, you can send in and request a change of request to change over to Global Accumulator. There will be an amendment that you'll get with the policy. You'll have to submit a new illustration with that. Yes, you could, if you've got a policy in underwriting currently that you haven't had issued or delivered yet, you can get that reissued or issued as Global Accumulator. You want to talk to the new business team, but I'm pretty sure that would just be an amending for the contract type at delivery. So if there's any contact info for who to reach out to when you have problems, and I would say our sales desk is a great resource for you. The number is 855-887-4487, and they're option 3. You can also find that information for them at globalatlanticlife.com. Contact information, you can reach out directly to them via that. They can help you with case design, and answering questions around the product. Any of those things they can help you out with. Don't hesitate to reach out to them. They're a great resource, great group of people. They're always eager to help anybody out there understand and build out a product. So I also have a question about if somebody has a current contract and they have Wellness for Life rider, and right now is the time to submit it, and due to COVID, they're not able to get into the doctor. Will we allow some time yet? Yes, I believe they will. They can go back and submit that, and I will do a little bit more digging on kind of what that timeline is or window is to have it go back and applied. But I will follow up directly with you, Dave, on that. And I see we have a couple of people raising hands. I'm going to try to, so Stephen Burke, I'm going to try to allow you to talk here, and hopefully we don't get any feedback, but we'll see what happens.